it's quite interesting that we've presented 110 different episodes of TechBiz, having different subject matter experts come to grace the platform. I think we've been fortunate enough not to even have somebody come back for a second time. So it's been 110 subject matter experts come to be on the platform and share with us from their wealth of experience. And it's an honor and an opportunity to have you be a part of it again today. And I just want to welcome you to TechBiz. TechBiz happens to be one of the expressions of Eco Innovation Center, where it's an innovation center that focuses on both early stage organizations, which are incubating and, of course, also helping to accelerate. And that's why we work through the value chain to make sure that we support organizations to move them from ideation to ability to scale up. And that's our mission. And TechBiz happens to be one of those expressions that allows us to be able to provide the right handholding and the right support for organizations to be able to achieve their aims and get to where they need to be. And so for us, TechBiz is an exciting platform for us that we love every Thursday, together with people across the different walks of life, across different locations, and to be able to think, dialogue, and learn together from subject matter experts on this platform. Again, for people who are just joining us, the 110 different episodes of TechBiz is also available. We've gone to the pain to make sure it's available to people who are joining for the first time and who want to see what we've talked about in time past, the business model canvas. We've talked about how to, intellectual property protection, how to launch a product, go-to-market strategy, how to investment readiness. A couple of those things have been done. And again, it will be nice for you if you have time. And my colleagues are dropping the link in the chat room. It's ecoeye.center/webinar, and then you can feel free to be able to see all the 110 episodes that we have. And of course, this particular one also will be up by noon tomorrow. You will find this 111th episode also up, and so it's a pleasure. But much more than the opportunity we provide for people to be able to learn, to converse, to meet people, and to learn from their wealth of experience. People have been through the journey who are subject matter experts. We also create a community of about 2,000, 3,000 people today, where on the go you can get all the support you need. On the go you can be able to a large extent ask questions. We can provide that hand-holding for you, and again, we have that community, and my colleagues will be dropping the chat for you to be able to join the Tech Nations, where myself, other facilitators who have facilitated different TechBiz sessions in time past, you can ask them questions, you can tag them, send to their DMs, and they will be there to be able to provide the support. Remember that ultimately one of the things that we think is required for people to scale and get to where they're going at a time like this, hand holding, quite okay. It's not just investments that we've seen, it's making sure that holistic experts. I'm excited to have it here. And today we're going to be talking about navigating the startup funding galaxy, unlocking secrets to secure investment for tech venture. I'm sure you know that this is a relevant topic, especially
Okay, so it seems VA is having some internet challenges. Okay, I can see it's back.
about that. I think the internet just went. I'm so sorry. I hope you all can still hear me. Can I just see thumbs up if you can still hear me? Do you hear me? Oh, beautiful. Thank you so much. Thank you. So again, it's what it is. Is we're in emerging markets, when developing worlds, and so these things do happen. I mean, the internet just sees. And so today, again, as we are beginning to see how startups pass through the investment winter, and people are asking, how do we come out of this? That's why we thought this is a relevant topic, helping people to unlock secrets to secure investment for their tech ventures. And we have somebody who is an expert, subject matter expert in this in every way. Excited to have her on the platform. And of course, for her, it's a pleasure to introduce her. She's the managing director of one of the biggest accelerators that you have, and I will talk about that later. And is the world's most active pre-seed investor and most active startup investor in Africa. I mean, it's for me, it's been a long time coming to see when I'll be able to have her on the platform, host her, and then be able to just have those conversations. So bringing her on Techbiz for us is a big deal. Okay, she to a large extent she leads the ARM Lab Lagos accelerator for Techstars, providing valuable support to early stage investors. And again, we will talk about handholding. This is basically what she's done over the years. Before Techstars, she founded Moving Back, a platform connecting global talents to African opportunities. And why do we like to look at people's profile and bring people that also have been through this? Because they can empathize, they feel it, they understand it. They have been at both sides of the divide, and so they speak from an informed position. So she's founded before, and before that, she used to have a career at Goldman Sachs, where she managed family offices and makes significant contributions at Rulenberger Strategy Consultants. Okay, she's a global speaker on African entrepreneurship and venture capital. She featured in major media outlets. She holds an executive MBA from London Business School, a BSc in economics from the London School of Economics, and her journey is a testament of dedication, excellence, and of course, for her, we are fortunate to have her with us today. So I won't take so much time. She is the person we're supposed to be spotlighting. Please, ladies and gentlemen, join me to welcome Oyin Solebo, the managing director at Techstars, as she takes us through navigating the startup funding galaxy, unlocking secrets to secure investment for tech ventures. Oyin, you're welcome.
Thank you very much for the introduction, and I'm honored to be your 111th speaker. That's
okay.
Awesome.
Do we hear?
Oh, can you hear me? I can hear you, Benga.
Yeah, we hear you now.
Hear okay.
Beautiful.
Right.
Good. We hear
you. Might just be delayed. Okay, well, pleasure to be here, everyone. I'm going to share my screen. Okay, hopefully you'll see that now as I take you through navigating the startup funding galaxy and unlocking secrets to secure investment for tech ventures. So I'd like to take this conversation in 4 parts. First of all, just to make sure that everyone is on the same page, I will talk about what it looks like in terms of the current VC landscape and what the decline in VC funding that we have seen means for you as founders. Secondly, to ask the question, are you even investable? So what are investors really looking for, and do you meet that? Third, we'll talk about funding sources. These conversations very quickly steer towards VC, but there are other sources that founders should make sure that they're exploring. And then lastly, we'll talk about your approach for approaching your VC raise, the do's and don'ts of doing so. So first of all, to talk about the VC landscape. If you haven't already, I really recommend that you watch an event that happened earlier this week on LinkedIn from the team at The Big Deal. They presented an overview of Africa's VC landscape and funding trends, and there were so many great insights there. But for the purpose of this, I just want to set the scene by presenting this graph. So this graph shows that for the first half of this year, African startups have raised just $0.8 billion in funding compared to 1.8 billion the year before. Additionally, what you don't see here is that the number of unique investors has dropped by about 27% since the first half of 2023. Now, I don't show this to you all to scare you, but just to present the reality. And the reality is it has become harder to fundraise. The bar has become higher. However, for companies that are well positioned, they can close their round. So the question then becomes, are you what an investor is looking for? Are you investable? So what is an investor looking for? So one of the first things we're looking for is, do you have a winning co-founder team? By that, I mean, do you have good founder market fit? Are you uniquely positioned to succeed in whatever market you're playing in? And you can demonstrate this with domain expertise, with showing that you have some kind of unique insights into your customer base. Ultimately, you want to leave the conversation with the investor where they feel like they have learned something about the market from you. The second question is, do you have a well-structured team? So the main bases should be covered. Ideally, you should have a technical founder and a commercial founder, and there should be clear responsibilities. If you're working in a sector where domain expertise is really important, you should also be able to show that. We're looking for well-bonded teams. So I'm sure you have heard that one of the most common reasons for startup failure is that the team breaks up. So we want to see that the founders have a history of working together, that you know how to work together, you know your strengths and weaknesses. Please, if you are having co-founder issues, don't raise. It's not fair to you, to your investors, to your team, or to anyone else that really relies on your business to succeed. And then we're looking preferably for people that have prior experience of launching something. So have you been a co-founder before, or have you at least launched a product or a service or something elsewhere to show that you have things that you have learned from? And then we're looking at your character. Being a founder is hard, and the relationship with your investor should be one that is treasured. So we are looking for founders that have execution bias, grit, stamina, but also ones that are really open and transparent, because that suggests that you're going to have a good relationship with your investor. The next thing we're looking at is your traction. And as I mentioned earlier, the bar has become higher. So earlier in your development as a startup, we're looking for signs of product market fit. And that may have not been the case a couple of years ago, but now we are looking for those indications that you have built a product that your target customer loves. So what are some of the signs that we're looking for in terms of your traction? We're looking for hopefully exponential growth. So we're looking for exponential growth in a KPI that is ideally linked to value. So for example, your monthly revenue. And that should be growing month on month without the need for high marketing costs. We're looking for good retention. So as you should know, retention is this measure of people that try your product or service and they like it enough to come back. And retention is really important because it doesn't matter how many customers you're able to bring in. If you're unable to retain them, you essentially have a leaky bucket and a hole at the bottom of your bucket, and you'll never be able to grow sustainably. We're looking at signs of positive customer feedback. So if you are able to demonstrate through testimonials or other social proof that customers love you, that's a good sign of traction. Partnerships is also something you can show as a sign of traction. So can you demonstrate that other companies find you valuable because they are partnering with you? And then your product itself, what have you actually been able to build? Have you been able to get the product in the hands of the customers? And what have you learned from that? Because often a customer will use your product in a slightly different way to the way that you assume that they will. So it's great to be able to demonstrate what your customer loves and which features they are using again and again. So that's traction. The next thing we're looking at is the market that you're operating in. And the question is, do you have the potential to become a category leader? I could also have written here, do you have the potential to be a unicorn? But there is some debate around that. So I've been sensitive and said, do you have the potential to become a category leader? So we are looking for a big market size, and this is really important. I see so many great ideas and businesses, but when you do a bottom-up exercise of your market sizing, i.e. we look at how many potential customers can you get, how much would they potentially pay, and therefore what is your revenue potential, it's not exciting. And ultimately, to get VC funding, you want to show that you're operating in a market that has huge market potential. We ideally want to see expanding margins. So for each product or service that you are selling, how much does your company actually keep? And the higher this is, the more attractive your business is. Linked to this is how protected are you from macroeconomic tailwinds? So in Nigeria, we are facing high interest rates, high inflation, currency depreciation, and all of these things make running a business hard and make sustaining high margins hard. So if you're able to demonstrate that you can withstand all of this, this also points in your favor with investors. We're looking for a high LTV to CAC ratio. So LTV is your long-term customer value and your CAC is your cost of acquisition for that customer. You should be able to demonstrate that you can make multiple times more from each customer versus how much it costs to acquire them in the first place. We want to see how much capital it requires to unlock those improved unit economics. So those improved margins and those improved LTV to CAC ratios. You should be able to demonstrate that over time you can unlock economies of scale and improve those margins and improve your LTV. There are some investors that shy away from asset heavy models because of this reason, and there are some that don't. So it's good to know which investor you are speaking to, depending on what your model is. And then the regulatory environment. So if you are operating in a sector that requires high regulation, then we want to understand how you are solving for that and how potentially changing regulation may hurt or benefit your business. And then the last thing we're looking at is the product itself. So the question is, do you have a unique proposition? So we want to see your vision. We want to see what the potential is for your product or service. If you achieve your next immediate goal, does that potentially open up new opportunities for other markets or other products? How is your business ultimately changing your industry? How are people being affected by your business? How are you positively changing your country, the continent, the world? We want to see all of that. We want to understand your customer value proposition. So how are you adding value to your customer? We want to see that you've got a good understanding of your customer, the problem they have, and then that your product matches the customer and the problem. We want to see your competitive advantage. So what are the factors that are allowing your company to produce your product or service better, faster, cheaper than your rivals? Defensibility. So what is it that is creating a strong moat around your business so that others can't just pick up your deck and beat you at your own game? If you're able to demonstrate how things like data or IP or network effects or exclusive contracts or these kind of things are building a moat around your business, then it puts you in a stronger position. Okay. Other than that, so other than looking at the team, the market, your traction and your product, there are some red flags that will make you less compelling to an investor. And here they are. So the first thing is an unclean cap table. As you continue to fundraise, you will become more diluted as founders. The concern with that is that the more diluted you become, the lower your incentive will be to run the business and the less flexibility you have to give out equity for potential subsequent rounds. So we're ideally looking to see that your cap table makes sense for your stage of growth. And red flags look like founders that don't hold enough equity. So for example, as you go into your pre-seed round, we would still expect that after that round, you hold 70 to 80% of your business. If it looks like you're not going to hold that much of your business, then take a really close look at your cap table. We want to look at, another red flag is the distribution of equity between the founders. If it is illogical, if it doesn't make sense, that is a red flag. So for example, if the CEO and other key members of the C-suite team don't hold the majority and you perhaps have a chairman or something like that that holds a majority of your shares, then that is not a logical distribution of equity. Dead equity is also a red flag. So if, for example, you have more than 5% of your equity that is held with a non-operational ex-co-founder, that again limits your ability to fundraise in the future. Another red flag is founders that aren't focused. So we look for founders that have side gigs, or founders that are studying, or founders that aren't based in their key market, and see these as red flags. IP not being held by the company is a red flag. So if you do not hold 100% of the IP in your company, it is a concern. And then little runway is a red flag. So we want to invest in companies that are going to be able to go the distance. Therefore, do not leave your fundraise until the last minute. If you need to raise capital and you only have 6 months of runway, it is potentially too late, because that is how long it will take for you to raise. Don't leave it too late. So if you are unable to survive very long without follow-on funding, or if the founders are also paying themselves too much, these are considered as red flags. Okay, so that is how to make yourself attractive to investors and the kind of things that we're looking for. Next is a conversation of what are your options? What are your alternative sources of funding? And often the conversation goes straight to VC funding, but there are other sources to unlock. So first of all, other sources that you can unlock. First of all, I have to say this. Accelerators. So Techstars is a great example of another way that you can unlock funding. So the benefit of joining Techstars is that you not only get capital, but you also get a program where you are trained to build sustainable businesses, and you're provided with a community of other founders, investors, and mentors to help you build your business. Another source of funding, and often the first source of funding, is angels. So angels are individuals who typically provide relatively small checks, and they're typically your first check. This might come from someone that you know and trust, but a great angel looks like someone that comes with some kind of strategic influence. So perhaps they can open doors to increase partnerships or distribution opportunities for your product or service. Then you've got the VC, and that's what we often talk a lot about. So the VCs are institutions that typically come with larger ticket sizes. Unlike your angels, they typically have a quite predefined exit strategy. So they know what they're looking for. They know the return that they're looking for, and they know when they want to exit. You might want to actually ask the VC what their strategy is there, so you can be aligned. They're also more likely to want to be involved in key decisions and want to be updated on your KPIs and your financial reporting. Then you've got corporates. So corporates are often overlooked, but more and more corporates are looking to invest in startups now. And they do that for a number of reasons. So perhaps they're doing it because they are looking for return on investment. Others want to be able to distribute their product or service through you as a startup. And others are looking to embed your business into theirs so they can become more efficient, or so they can reach new customers. So think about the kind of corporates that might actually benefit from working with you, and see whether or not they have a corporate investing arm or a corporate venture arm that you can get in touch with. And then non-dilutive funding is a great way for you to raise money without you having to give out part of your business or take on debt. And this can take the form of grants or competitions. Often they have some kind of impact goal aligned to them. So for example, job creation, or maybe something linked to one of the UN SDG goals. Before you raise, look at how much you're spending. This will not only help extend your runway, but it will also demonstrate to investors that you have good financial management. So these are the things to look at. Make sure that you have the right team. We've all seen many cases of companies that have overhired and then had to reduce their staff when they couldn't fundraise. So do an audit of the people that you have on your team. This might look like you cutting costs, but it could actually look like you increasing your costs if you find that you need to hire more capable and senior people to join your business. That might increase your costs, but it also might increase your productivity and your revenues, and therefore help you extend your runway. Review the leadership team salaries. So I say this point again because we have seen a number of situations where founders are just paying themselves too much for their stage of growth. If you find that you need to cut salaries, the first place you should look to are the founding team. Now, I know that many founders are actually not paying themselves, But if you are founders that are paying yourself, then do just look at how much you're paying. Look to see whether or not you can swap international service providers with local ones that are charging you in local currency. So this might be your CRM, your telephone services, your accounting services. There may be local currency options that you can use that help you extend your runway. Look for where you can cut spend with low return on investment. So I see a number of founders, for example, going to international conferences and spending a lot of money on that. Before you spend money on anything, consider what is the return on this investment? And then explore credits, explore other opportunities for free money. The likes of AWS and Google Cloud and other providers provide credits to startups using their services. Look to see if these are applicable to you to help you reduce your runway. Extend your runway and reduce your monthly burn. Next, if you need more money, look to see whether or not you can actually do that by generating more revenue from your customers. Some things that you should look at are, first of all, increasing your conversion. If you have a low conversion rate, so if you're approaching a lot of customers but are unable to actually convert a good percentage of them, then it's likely that you haven't carefully defined your ideal customer profile. So make sure you understand your customer. And make sure that you have then built a product or service that they actually love. And the only way you can do that is by spending a lot of time with them. Spend time with your customer, understand them, understand their pain, and understand if you are building a solution that they actually love. Explore partnerships. So there are many of you, I imagine, even on this call, who are building for a similar customer, but building different propositions. Check to see if there are ways that you can partner together to provide more value add to your customer base by partnering. Look at how you can increase your basket size. So consider if you can actually, instead of spending money to get more customers, if you can increase the amount of money that your existing customers are spending with you by upselling something or selling more to them. Again, this requires you spending time with your customers to understand who they are, what their pain points, and how you can solve them. Reduce your churn. So as I mentioned, a key determinant of product market fit is your retention. If you are losing customers month on month, again, you have this you have this hole in your bucket. If your churn is high, it's futile you're getting more customers because ultimately they will leave. They might even spend bad press, bad feedback about your product or service, which will make it harder for you to acquire more customers in the future. So look at your churn. And then look at how you can incentivize referrals. So hopefully your customers love you and are naturally referring you anyway. But if not, think about, are there opportunities for you to incentivize them so you get more revenue? Okay, so now assuming that you have done all of this and assuming it makes sense for you to then raise, here are some things for you to think about. So you want to be as strategic about your fundraise as you are about your business. Having a good strategy means that you will increase the return on investment of your time. It also avoids you looking like an amateur because investors ultimately talk. It will help you increase your chances of success, and it will also reduce your chances of taking a bad deal. I have found founders or worked with founders that after they have fundraised, they then say, I really wish I didn't take that deal. And if they had a good strategy, then perhaps they wouldn't have. So what does a good strategy look like? Well, before you even speak to investors, you should look at these different steps. So the first thing you want to do is figure out how much capital you need, what instrument makes sense for you, and what is the source. So as I mentioned earlier, VC isn't the only source of capital. You can also look to accelerators, angels, corporates, and non-dilutive funds. You also want to consider the instrument. So we talk a lot about equity, but debt is making an increasingly bigger portion of the money that is being raised through venture funding. So debt is, debt obviously means that you are borrowing money, whereas equity means that you are selling a portion of your company. The main advantage of equity is that you can take money with no obligation to repay the money. However, there is the increasing expectation that you would repay that if you find that the business is just not going to succeed. Whereas debt is putting burden on the company. You're putting burden on your company because you need to repay that, and therefore you need to have really healthy cash flows. But the advantage is that you aren't giving up part of your business. So consider the how much you need, the instrument, and the source. Next, and I'm going to go through this in more detail, is you want to build and manage an investor CRM. So similar to how you might do with your sales pipeline, you also want to have a CRM pipeline for your investors. Next, you want to be prepared with all your material. So I have seen founders who go on into investor conversations and then they aren't ready, they don't give the investors the information they need, and then they end up wasting that opportunity. So I'll take you through some of the collateral that you need. Next, do mock interviews. So do mock interviews with existing investors, with mentors, with friends that you trust, before you actually connect with and engage with investors. And hopefully after that, you're closing your deal. Let me go through some of that in a bit more detail. So first of all, this piece around connecting and managing your investor CRM. So how do you identify target investors? So you should have a CRM of investors that you want to reach out to, and then you should prioritize them and be really strategic about how and when you approach them. For example, if you have some investors that you really, really want on your cap table, you might not want to reach out to them immediately. You might want to make them the second bunch of investors that you reach out to so that you can learn from the conversations you have with your first bunch. But anyway, here's how you can identify investors. So first of all, ask other founders who have raised. Other founders who have raised are a great source of knowledge on which investors are actually investing, which ones are better than others, how to manage those relationships, etc. And one of the benefits of joining Techstars, for example, is that you have this network of alumni who can refer you to investors and give you feedback on them. Ask your current investors. If you do have investors already, angels or investors that have invested via an incubator or an accelerator, ask them for referrals. Keep an eye on the press, keep an eye on socials, keep an eye on blog posts, see who is closing funds, see who is raising in your sector, and look at who those companies have raised from. So if you are doing something in fintech and a fintech raises, look at the investors that they're raising from and add them to your CRM. Next is events. And I spoke about not spending too much money on events, but if you go to events, make sure they're targeted, make sure they're the right ones. And if you're approaching investors at events, please be prepared. So make your time count. Research investors, and I'm going to talk about this next. Research investors before you speak to them, so you're having the right conversation with them, and then be ready with your short 1-minute pitch on what you're doing, and watch out for body language. If it looks like the investor is not so engaged in the conversation, be sensitive to that. And also be clear on your ask. Is your ask that you want another meeting to tell them more about your business? You want to give them a demo? You want to share your deck? Be super clear on that. Excuse me. I mentioned this before, but research companies in your space, see who's investing in them, and add those investors to your pipeline. And then check out databases. Check out databases like Crunchbase, Big Deal, etc., who will have lists of investors that might be relevant. Okay, thank you. I unmuted there. I'm now not sure if you're seeing my screen, so let me start sharing again. 1 second. Ooh. Okay, hold on. Okay, all right. Hopefully you can now see my screen again. And let me skip to the page that we were on. 1 second. Okay, so we were talking about your strategy and your investor CRM. Okay, so you also want to vet your target investors. So do your research, as I mentioned. Your time is the most precious resource that you have. So don't waste your time talking to the wrong investors. Before you engage with any investor, check that their thesis aligns with what you are building. So it's as simple as, do they invest in your sector? Don't waste time speaking to an investor that only invests in health tech if you are a fintech. Check the stage and check size. So check that they are investing within your bracket. If you're raising a pre-seed, there's no point you speaking to an investor that only invests in Series A. I mean, there may be a point in terms of getting into their pipeline, but it's not the conversation you want to prioritize. Check for the portfolio companies. So know who they have invested in, especially if they have invested in competition. There are some investors that will say, no, we don't want to invest in too many companies that are competing. But then there are others that will say, we have a really strong thesis. We really love this particular niche in our sector. So we will invest in multiple companies that may be competing. See if you can find out if they're actively investing. So some investors are not actively investing. So you might be able to ask them that question, or again, ask people that you know, ask other founders if they have any insights in investors that are on their cap table. And then do DD on the investor. So not all investors are equal for what you may want. Ask founders for feedback on those investors. Ask about the process, ask about their value add, and make sure you're prepared to have the right conversation with the right investor. Next is the collateral. So I mentioned be prepared. I mentioned the fact that I have seen startups go into conversations with with investors. Investors then say, give me your data room. Show me your historical finances. Show me your business model, and they aren't ready. So make sure you have this material ready before you go into those investor conversations. This is a really long list of information, but you want to make sure that you've got all of this covered. So you've got your background information in your data room. So your pitch deck, your organizational structure, your hiring plans, your FAQs. And what I mean by that is if you are asked the same question again and again by an investor, put it in a document and write that perfect answer and put it in your data room. You want to make sure you've got all those legal documents ready, your incorporation document, your cap table, shareholder agreement, founder agreement, trademarks, all of that stuff in one folder. You want to make sure you've got all your material regarding your employees. So your employee lists, profiles of key members of your team, employment agreements, your non-disclosure agreements, your IP assignments from your developers, your option plan documentation if you have it. You want to have information on your product and commercial strategies. So your go-to-market plan, your product roadmaps, your key customer contracts. You want to have your financials ready. So you want to have your historical financials ready, as well as any signed financing documents you already have. And what's missing here is your financial model. So what do those projected finances look like for the next at least 3 to 5 years? Now, we know as investors that your financial model will change as you learn more about your customer, but this is a really great way of showing that you are thinking about all of the key variables as your business continues to grow. And then compliance. So anything that you need from a compliance standpoint, like your licenses, your permits, evidence of tax compliance, make sure that you've got all of that ready. I mentioned keeping investors engaged. So when you have spoken to investors, you want to keep on having conversations with them, and you want to make sure that you build this fear of missing out to get into your round. And the best way of doing that is by sending regular company updates. So monthly emails at the least to show key information. Now, if you are sending these to prospective investors, And if you're already sending them to existing investors, you might want to send 2 different versions. For your prospective investors, at the least, you want to include in your company updates your elevator pitch. So don't assume that the investor remembers who you are. You want to include your KPIs. So what are your key measures of success and how are they improving over time? It's great to be able to show an investor with every month that your revenue or your number of customers or your retention is improving. You want to show the good, so the highlights of what's going well in your company, and then any other key updates like your hires. Now, finally, some do's and don'ts. So other than what I've said, be aware of these final do's and don'ts. So on the do side, do assume that fundraising as the CEO will be your full-time job, and ensure that you have a team that is prepared in your absence to continue growing your business. You don't want to be the only person that is generating revenue in your business and have your business slow down whilst you are fundraising. Do build relationships and start early. Assume that it could take 6 months for you to close your round. If you meet an investor that you like, but you're not ready to raise, add them to your company updates so they remember who you are when it is time for you to fundraise. Send those regular company updates. So as I mentioned, this is a great way of keeping your prospective investors informed of your progress, and it creates fear of missing out. Do ask the investor about their investment process. So different investors will have different processes. Ask them what it is so that if you are perhaps steering off course, you know. It sounds weird, but you want to get to a fast no with an investor. It's better to get to a fast no than to drag on the process so that you are speaking to them again and again and you're chasing them and you don't know where you are in the process. And a great way to be able to get to that is knowing what their investment process looks like upfront. Ask for advice and feedback from the investor. Even if they say no to you, you want to ask for their advice so that you can use that as a weapon to go into the next conversation even stronger. Keep FAQs, as I mentioned. Write down the questions that you keep on getting. Write down the perfect answer so that you are armed with that in your next conversation, and add that to your data room. It's a great way of showing that you are thinking. Do ask for references from the investor if the investor is making progress. If they want to invest, ask for references and speak to their portfolio founders so you know what to expect in that relationship with that investor. And remember that investors talk. You want to leave a positive impression regardless of the outcome. And some final don'ts. So don't just send blanket emails to all of your investors. Try to send a meaningful email. For example, reference something that you spoke about. And make sure that you get the company right. There's nothing worse than getting a cold email from a founder and they mention a different investor. Don't hide anything. Assume that you will be asked at some point. So be really clear on the things that may be red flags and solve them or deal with them upfront in conversations. Do not ask for an NDA. They won't be signed. You'll be wasting your time. Do not share with the investors who you're speaking with. This can actually go against you because the first thing those investors will do is swap notes. So that's not a great way of creating FOMO. You can say to them, we've got this amount closed, or we've got this amount in offers, but you probably do not want to tell them who you're speaking to. They might find out another way. It doesn't need to be through you. Don't waste your time with no's. So as I mentioned earlier, you want to get to a fast no, and then you want to get feedback from them. You want to add them to your company update so they get that fear of missing out, and then you want to move on. And don't create a reason for the investor to wait. So for example, you don't want to go into those conversations and say, hey, there's this big partner that's coming soon, because what an investor is hearing is, I'll wait for that big partner to come before I take you seriously. So those are some don'ts. And with that, I think I'm in good time for questions.
All right. Thank you, Owen, for that robust presentation. Yeah, I'm sure all our listeners, they've learned quite a lot. We have a couple of questions in the chat section. So let me just quickly read through. The first question I have here is, can an MVP product apply for funding to develop a product market fit?
Yes, yes, absolutely. So yes, if you have an MVP, you can apply for funding. But what you want to show is that you've got some kind of early indication. So what is product market fit? It is that you've got a customer. So you know the customer, and you know the product that you're building, and you have evidence that they love the product, so they are buying it, right? So you have those three pieces: the customer, the product, and the market. You want to show some indication of that, even if it is at the MVP stage. So for example, at the MVP stage, what you may be able to demonstrate is that you know the customer really well. Maybe you've surveyed them, maybe you've spoken to them, you've done deep customer discovery to say, this is what our customer looks like, this is the pain point they have. On the market piece, it might be that in your MVP, you've built something really, really crude that you can get to market and already have customers purchasing it. So that shows that you've got a customer that is willing to buy your product or service. So the answer is yes, but you need to figure out ways to demonstrate early on that you've got signs that you will achieve product market fit.
All right, thank you for that. That will lead us to the second question, which states, what are the best strategies to pitch an MVP to potential investors?
Yeah, great. So it comes to the problem and the customer. Like that is the most important thing to get right. So talking about your customer is really, really important. Let me take this the other way. What I often see with MVP pitches is really smart founders showing me a great product. And I'm like, that looks really awesome. And they spent months building it. But then I say to them, what evidence have you got that the customer actually wants this? And what they find is that they've wasted their time. They've wasted their time and their money building this thing that customers actually don't love. So it goes back to being able to identify who your customer is and the problem that they have and being able to demonstrate that.
Okay, we have a third question, but before we go into that, if you're currently joining us on Zoom and you want to ask your question verbally, feel free to raise up your hand so the team can unmute you to ask your question. If you're joining on YouTube, Facebook, and every other platform, feel free to drop your questions in the comment sections. We have the team members on board as well that will drop these questions here for Oyin. And to the third question, what are the essential elements of a compelling pitch deck for tech ventures? Oyin, you are muted.
Thank you. Sorry, I've got a bit of a cough. So the compelling part. So the first thing I would say is that you might have two different versions of pitch decks. You might have a pitch deck which you use when you're presenting, where you really want the person that you're presenting to focus on you. So it might be light on text. And then you may have another version that you actually send to investors, which is heavy on text because you need to describe things. So that's the first thing. The things that you should include in your pitch deck. So first of all, what is the problem that you are solving? So I say this all the time, problem is really, really important because we know that for early stage founders, you will probably pivot your solution at some point. So what is the problem that you are solving? Next, you talk about your solution and the customer. So what does the customer look like? What is the profile? And how are you solving the customer's pain point through your product or service? You want to talk about your market sizing. So ideally, you want to be able to say that this is the total addressable market that we can identify. And what that really means is this is the total amount of money that can be made by serving customers with a product or service like this. And ideally, you want that to be $1 billion plus. You then want to hone in to talk about your serviceable, obtainable market. So who are the customers that you really think that you are going to obtain, because you're not going to be a monopoly? Who are the customers you're going to obtain, and what markets, and how much money can you generate? So you want to look at your market sizing. you want to look at you want to show your competitive advantage in your competitor landscape. So who are the main competitors that you are competing against? This may be existing products or services, or if you're kind of or operating in a market where there actually isn't already a tech solution, it might just be that your competition is paper or Excel sheets. But you want to demonstrate that you understand who your competitor is, and you can demonstrate why your product is better, why it's cheaper, why it's faster, and why you will win versus your competition. What have I missed? Your pricing model. So you want to talk about how you are actually generating money, right? So don't leave the investors saying, okay, this sounds great, but how are you actually generating money? You want to be able to show how you're generating money, what your pricing structure is, and perhaps what those additional value-added services are that will allow you to generate more money in the future. And then you want to talk about, sorry, one more thing. You want to talk about your traction. It's important. Your traction. So what have you achieved to date? Ideally, you want to be talking about revenue, but if not revenue, then something around customers that you've acquired, something around perhaps funding that you've raised, something around partnerships, your product development, but what is it that you've already achieved so far?
Okay, thank you for that robust answer. I have another question here. How should a startup determine its valuation before seeking funding? There is a follow-up to that, which states, what are the common pitfalls to avoid when negotiating equity with investors? So it's a 2-in-1.
Okay, thank you. So valuation is a really tricky one when you are really early stage, because ideally valuation should be based on, for example, a discounted cash flow assessment of your business. But when you're really, really early, we're unable to do that. And that is why companies like Techstars, we just give you a flat valuation cap for your convertible notes. I'm not sure you'll all understand what that means, but we start with a valuation cap of $3 million. Because that just sets the benchmark for all founders, and then we go up after that. But the ways to determine your funding is you can look at comparables. So look at other companies in your sector, look at how much they have raised, and then try to do an assessment of what stage they're at. So for example, you might want to look at what the multiple of their valuation is versus their revenues or versus their customers. So that's a great thing to do, but the reality is that you are valued at whatever someone is prepared to pay. And there are many investors that just have a benchmark. There are many investors that say, for pre-seed, we won't go above 5 million. And that is just a situation that you'll find yourself in. The other thing that you can do is ask investors how they are valuing you. So some investors may have a scorecard that they are using that they will check off to see how much that they want to offer you. The other thing I would say for that is it goes back to your fundraising strategy. You want to determine how much money do you need to get to your next milestone. And that milestone should be around 18 months. How much money do you need? And then work backwards. How much of your business can you actually give up to make sure that your cap table is still clean? And quite often that reverse engineering tells you the kind of valuation that you're looking at. The second question around negotiating common pitfalls. When negotiating, I assume that means when negotiating a valuation. I guess a common pitfall would be talking about valuation too soon, without actually knowing that the investor is interested in you. Another common pitfall would be not knowing how much money you need, and therefore what the baseline of your capital, of the baseline of your valuation is. So for example, if you know that you need $1 million to get through the next 18 months, but you know that you can't give up more than 20% of your company, that immediately tells you that your valuation should be at least around $5 million, right? Just from that reverse calculation.
All right, thank you. There's one more question this should be from Facebook. So how can startups maintain a good relationship with their investors post-investment?
Brilliant. Thank you for that question. So I mentioned investor updates or company updates. What you should definitely be doing with your investors is sending them regular company updates. And those company updates, they may be monthly while you're fundraising. If you're not fundraising, they should ideally be at least quarterly. They should include your KPIs, the goods, But if it's for existing investors, also include the bads. Tell them what's going wrong in your business. Remember that you are on the same side as your investor. You both want to succeed. So tell them what's going wrong. Ask. Have a section called Asks where you're actively asking your investor for specific help. That might be help with hiring. It might be help with just problem solving. It might be help with new distribution partners, and get the investor to work with you to support you in that. So that's the first thing, your company updates. The second thing is when your investor asks you for data, make sure you give that information. I see many situations where investors are asking for information because they have information rights, and founders are not giving them information. That is a really bad way of maintaining a relationship. And then have regular conversations with them. Speak to the investor to understand what the cadence of that is, but actually get on a call with them, actually meet with them to have regular meetings so that you're keeping that relationship alive.
Wow. Thank you, Oyin, for the presentation. We have a lot of valuable insights, a lot of nuggets for the community. We have about 3 minutes to go. That will be all the questions we can answer on this episode of Techbiz webinar. And for all webinar episodes are accessible on the website. You go to www.ecoicenter.com/webinar. You can find all previous webinar episodes on this portal, including today's webinar. Before noon tomorrow, we'll find the video recording there. You can go back, listen to it. Also, this is also an invitation for our community to join, to register for Art of Technology Lagos 6.0, which is focused on AI and the Lagos digital economy. AOT is our flagship event. We've been doing this since 2019. So this is an opportunity we are sending an invite to everybody to register for this, for AOT Lagos 6.0. Also, we have our Techbiz Nation community, a community of over 2,000 people. We are on both Telegram and WhatsApp. I'll have the team drop the link to the community on the chat session. Thank you, Oyin. Thank you for honoring our invitation. Thank you for the presentation. And then we call it a wrap for Techbiz webinar, the 111th episode. See you guys next month, the last Thursday of August, for the 112th episode, where we'll bring another subject matter expert. Enjoy the rest of your week. Bye.